We're going to begin our afternoon session. And I'm going to be turning it over soon to my colleague, my partner in crime from the Volatility and Risk Center, Dick Berner. Dick is the co-director of that center. And if I can give a little plug, they're doing some phenomenal stuff on climate change. So you might want to check out their website. Dick comes to us from both government and from financial services. He is an economist. And Dick, the floor is yours.
Okay, thank you very much, April, and thanks for your collaboration in organizing this conference, which has been terrific so far. This afternoon, we have a fantastic panel, I think, to address a lot of the questions that have been raised already, but specifically the regulatory focus on them. Professor Yermak and others raised a lot of questions about benefits, the risks, the case for, and some specifics regarding regulating crypto assets. And we've got a great panel to do that today. First, my colleague, Hanna Halaburda, who is Associate Professor of Technology Operations and Statistics at NYU Stern. And if the panelists could turn on their cameras and their mics, that would be great. Second, Matt Homer, who's at NYCA Partners now and former Executive Deputy Director for Innovation at the New York Department of Financial Services. And Jai Massari, partner at the law firm Davis Polk, with a focus on digital assets and crypto. So let's get right to it and start with our questions, which to some extent go back to basics, but I think it's worth exploring them. What are the benefits of crypto assets for consumers, businesses, and the financial system? We all benefit from innovation in various ways, but we also want to know what are the risks? And I'm going to start with you, Hanna, and then go to Matt and Zai.
Thank you, Dick. And let me start by thanking you and your co-organizers for setting up this panel, and my great co-panelists. I'm looking forward to this discussion very much. So let me start with benefits. I think we are going to focus on the risks for the most of the panel. So let me start with benefits. And there are a number of current and potential benefits to crypto assets and generally what blockchain technology has to offer. First, as David Yermak earlier pointed out, a lot of the ICOs brought a lot of profits to some investors. I mean, a lot of them failed, but a lot of them brought profits. Crypto assets are a new asset class, potentially new asset class. It's very volatile. Volatile asset classes may bring profits. This is a clear benefit. Then we actually see benefit in use of crypto assets or cryptocurrencies. So most of the cryptocurrencies are not used to buy a cup of coffee, but it turns out that they are useful as even as payment or as transfer mechanism for cross-border payments in environments where the international banking is not very efficient. It also is used, for example, in private aviation. Turns out to Bitcoin turns out to be quite useful method of payment. Of course, on the downside, on the other side, there's a lot of illegal activity that is related to the use of Bitcoin as a payment system. So for every benefit, there's a downside. For businesses, crypto assets offer programmable money. And that may open up possibilities for a lot of uses of crypto assets as strategic tools. So we have seen that a little bit already in utility coins and NFTs. And I think that there is a large room here for further innovation in this space and use of those of this technology for the use of for businesses as strategic tools, complementing whatever they are already doing. And then finally, we can talk about the whole realm of DeFi. And DeFi is permissionless, and permissionless means that almost anyone can access DeFi, and both on the side of using the services that are offered in decentralized finance, for what DeFi stands for, but also in offering those services. Anyone can offer the services. And that means that there's a lot of innovation. And on the flip side, of course, there's a lot of services that are being offered that if they would be offered in a traditional space, they would be outright criminal. So we have Ponzi schemes governed by smart contracts, and we have front running on the decentralized exchanges. So on one hand, great access, great innovation. On the other hand, everything bad that may come with this innovation. So I think I have covered what I think are the most important benefits, and they mostly come with the risks.
Thanks. That's fantastic. And, I would just add to that, obviously this new asset class has information content, which is one of the great benefits of our financial system. Matt, what would you add to what Hanna has said on both sides?
Yeah, I think so I think if you think about crypto assets, of course, there's the assets, and then there is there are the blockchains of those assets sort of are, sit on top of. And I think it's important to sort of think about those two different pieces because they are, very interrelated and codependent. And I think that, what excites me the most in terms of benefits is the infrastructure. So I am sort of less interested in any particular asset. And I mean, I'm interested in it, but I'm less interested in that than the infrastructure that sits around it and enables it. And there it's, it's a little bit like, the beginning of the internet. We were all getting on the internet. We were logging on our modems to get on the AOL. And, we were trying to figure out what we could do. And, you could look at the newspaper. You could look like a digital version of like the newspaper, and, you could do a few things. But, I don't think at that time any of us, would have been able to imagine just like the myriad of use cases and ways in which the internet has changed our life. So in some ways, I think it's, the benefits, and it's part of what's so exciting about it, is the benefits are, sort of untold, I guess, and we don't yet know all of the benefits. But I think that, a few things. I think one is like the modular nature of blockchain and smart contracts, and the ability to kind of enable an infinite variety of different products and services to meet an individual or institution's need. I mean, to me, that's very exciting, and we're seeing basically the replatforming of financial services. I mean, any type of financial product or service that has existed in traditional finance is now being built on top of crypto rails. And you're seeing a lot of interesting challenges, growing pains for sure, but I think the benefits are several. I think one is greater resilience with these distributed networks. I think efficiency, not always the case, actually, right? I mean, some of the there are gas fees and stuff is not always the case, but I mean it I think is certainly part of the promise there. And you're seeing greater accessibility. And I think cost too. It sort of depends on the specific product or service you're thinking about. But I think one of the use cases Hanna mentioned was international settlements, and the use of stablecoins there is really, I think, is important. And there you do see as reduced costs. I think, and then on the consumer side, you're seeing some interesting use cases for sure. I mean, I think the one that I'll just talk about, kind of one is not within that I'm really excited. I'm just gonna personally think it's fun. If people are looking for examples, is the Brave browser. So the Brave browser, it's a privacy browser, and it basically flips the script on the economics of how advertising works, so that you as a consumer, using the browser, you're paid to view, the advertisements that are served up to you with a token called the BAT token. And so it's just sort of one example, but I think what's exciting about where we are now is that we're starting to see this proliferation of use cases, whereas for a very long time, the main use case was speculation and just holding these assets. And now we're seeing much more utility. But on the risk side, I agree with I think the only things I would maybe add are that I think Hanna talked about illicit financing and some of the other areas. I think cyber continues, to my mind, be one of the most important and significant risks, and one that is actually, I think, sometimes gets less attention than the other risks, even though it should get more attention. I think sometimes, it's just the way our regulatory system is structured, certain risks get the most attention, even if those are not the biggest risks. And I think cyber is an example of a risk that is very important, and probably hasn't received as much attention as it should. And I could keep going, but let me pause there.
Okay, great. And Jai, as a cleanup batter on this question, obviously the cross-border implications are important, as both Hanna and Matt mentioned, particularly because obviously we have different laws in different jurisdictions. So give us your perspective on some of these issues, both on terms of the benefits and the risks.
Yeah, thanks, Dick. And again, I'll echo Hanna's comment. Thank you for inviting us to speak. This conference is terrific. Look, as a practicing lawyer at a law firm, I think I'm probably in the worst position to really think about the benefits and of the technology, because I'm not a technologist, though I also dream about things, right? So I agree wholeheartedly with Matt that we don't know, right? We don't really know what the ultimate benefits of the technology are, but that's exciting. That's not a problem, right? That's an exciting thing. And from my perspective as a financial regulatory lawyer, I've spent my career working with financial institutions and more recently technology companies, and tend to spend a lot of time thinking about how financial transactions work. And I think, again, echoing both what Hanna and Matt said, I think there's tremendous potential for digital assets and their underlying blockchain infrastructure to make the way financial institutions and also consumers, how we all do financial transactions, more efficient, more streamlined, and also more cross-functional, right, across different types of assets. Because at least in the United States, I think this is generally true around the world, our clearing, settlement, transaction systems are quite siloed among different types of assets. And with the right sort of creative regulatory thinking, I think that actually blockchain technology and the digital assets that ride those rails can provide a way for things like faster settlement and clearing of programmable money versus programmable securities, for example. And to me, those things are very, very interesting. Maybe not as like glamorous as NFTs and Beeple, but arguably fundamentally more important to our day-to-day lives. Not saying Beeple's not important, but.
And Jai, as a lawyer, obviously you focus on pointing out risks to your clients. What about some of the risks that you worry about?
Yeah, I think, look, I think a lot of the focus, and I do a lot of work on stablecoins. I think, stablecoins are a great example of a case study, really, and how regulators are thinking about risks in these areas, right? Stablecoins are essentially a new type of private money. They actually look a lot like existing types of private money, and frankly, raise all of the same risks that other kinds of money raise, right? Whether it's bank deposits, e-money, stored value, right? And that those risks range like literally all financial regulatory type risks, right? Financial stability, for sure. Financial crimes, consumer protection, transparency, data privacy, like you name it, digital assets have it in terms of risk, particularly as they scale, right? I think one thing that we're really starting to see is the overall digital asset market is scaling really quickly, has seemed to really gain momentum, and that's why you have a regulatory focus on the risks. It's not that they weren't there before. It's just, to use the technical term, it's all started to get really real at the moment.
Fantastic. So, my next issue is what's the case for regulation? And it sounds like in all of this discussion, both this morning and here implicitly, we've made the case that with risks, there is certainly a case for regulation. But given the fluid nature of this of all these assets and indeed the technology. Our regulatory process typically moves with glacial speed, and we have to adjust and make more agile that process. I'm not sure how we balance that with making sure that it's, appropriate and doesn't impede innovation, but that's certainly one of the aspects of this. In this case, Matt, being a former regulator, I'm going to start with you to discuss this issue a little bit and tell us about the case for and what we need to do to get appropriate and balanced regulation for this asset class.
Yeah, thanks, Dick. So I think, I think it's important to take a step back. We just talked about the risks. I think it's important to also take a step back and think about what does the state of adoption look like, because the state of adoption is very different than it was a few years ago. We have seen over the last 2 years really a dramatic mainstreaming of the crypto space on both the retail and institutional side. So on the retail side, the estimates regarding ownership of crypto assets vary quite a bit, but at the low end, I think it's safe to say at least 10% of Americans own crypto assets, and there are many surveys that point that out. There's some surveys that have much higher estimates that I find harder to believe, but I think that 10% seems reasonable. So that's a very significant number of people. It used to be that if you wanted crypto, you would have to go to the crypto. Now the crypto comes to you. So now financial institutions that you already have a relationship with are now offering crypto. So PayPal, right, is an example. Square is an example. You will, I think, increasingly over the next 12 months, see banks allowing customers to buy, sell, hold in crypto, and that will become, I think, it will become table stakes for institutions that want to appeal to digitally native customers. So you just see this, and then on the institutional side, I mean, every day, right? Fidelity is hiring 100 people, and there's so much happening on the institutional side. So that is another. It's not only the risks. I mean, the risks have always been there. It's the fact that the people who are participating in this market are now broader. It's no longer just a space for hobbyists. It's a space for where everyone, I think, is sort of asking whether they should participate in the space. I would just mention a couple other things. I think there already is regulation. I think that I've been a little dismayed to hear some statements from Washington that crypto is unregulated, because crypto is subject to many different sets of regulations, and of course New York State, where I previously worked, was one of the first states to come out with a regulatory framework for crypto. And I think that that is actually sort of a good case study, the New York experience, for things that you could do differently, as well as kind of making the case for why regulation is needed and what works. So I think we've seen a few things if you think of New York as sort of the case study. I think that New York came out with the BIT license in 2015, and there are a lot of people who didn't like it. There's still a lot of people who don't like it, but I actually think it has had a pretty significant role in legitimizing the space and the mainstream of the space. And I think if you look at the companies that in New York that have embraced regulation, they've actually done pretty well. And when other participants in the market, whether it's banks or whoever, are looking at who to partner with to enable crypto, they're often looking at New York regulated entities. And so I think that regulation is it's sort of in everyone's interest. It's important to build trust with consumers. It can bring legitimacy to market participants, and it can help even the playing field, among competitors. So everyone's playing against the same set of rules. So I think the question now is not really whether it should be regulated, but how and by whom, and what's the process for getting there, as you pointed out, Dick. And I have some thoughts on that too, but I will wait and see. We might get to that a little later.
Yeah, let's come back to that a little bit. Jai, that's a great segue to you. What are your thoughts here?
Yeah, so Not to be too facetious, but obviously I love new regulations, right? It keeps me in a job. But actually, I think we see this story play out again and again in the history of financial regulation. And again, yes, there are some digital assets that are just not financial products, but largely so far they have been. So I'll talk in terms of financial regulation at least. One of my clients actually used a really great analogy, and he said, look, when you have lines painted on the road, everybody gets to drive faster in the end, especially on the highways, right? When you have on-ramps and off-ramps that people actually can see and use, everybody gets to go faster. And I think that's a really nice way to put it, which is, when an industry starts, I think it's really important for the 1,000 flowers to bloom, right? But over time, as an industry scales, affects more and more consumers, and is fundamentally engaged in financial services, we see Congress and regulators start to say, wait a second, we need baseline consumer protection. We need baseline regulation of market activity. So disclosure, fair dealing requirements, rules governing market activity. We need to make sure that our financial crimes considerations are addressed. And I think, yes, I 100% agree with Matt. I think the New York bit license regime did a lot to start that process. I think there are still gaps in the regulation, and improvements could be made. I'll stay neutral on who does the regulation, whether it's the federal government, whether it's the states. I think we have a federalist system and there's a place for everybody. But I think that regulation is fundamentally necessary for the industry to drive faster. And I think the other obvious piece is it's also necessary for consumers both to actually be protected when people behave badly, which sometimes happens, but just to have a fundamental level of trust in the system, right? I've certainly been part of conversations where people are shocked that their crypto accounts aren't protected like their securities accounts and bank accounts are with insurance, right? They're not. So those are the kinds of things that I think just need to be in place to maintain consumer trust in the industry, or establish it in some cases.
Great. And Hanna, you have deep expertise in the technology and innovation. So the question I have is, we've heard the affirmative case here for regulation, which seems very logical, but are there problems involved in regulation and the implementation that might interfere with the innovation?
Yeah, so on one hand, we, just like Matt and Jai said, we do need regulation, and regulation is actually needed as both it contributes to the mainstreaming of crypto, but then as more people are coming in, people do not understand technology, and regulation would be helpful in protecting them from the risk of the technology. So initially you would have enthusiasts that were getting into it, and they knew the risks and they were accepting the risks. But now most people don't really understand the risks. They think that Bitcoin is immutable and there is no possibility of double spending, and then they are surprised if other cryptocurrencies with exactly the same protocol are subject to double spending, because they do not understand that the protection comes from very high price of Bitcoin and not necessarily from the protocol only. Another example is recently I have heard about a fake NFT that was supposedly issued by Banksy on his work. The thing is that there was nothing fake about the NFT. NFTs issued on Ethereum on permissionless blockchain can be issued by anyone. It just the website made people think that it was issued by Banksy, but nobody really accredited Banksy. That saying that nobody said this is really Banksy's NFT. NFT was fine from the technical point of view, but it was not what consumers were expecting. Right, so this is where we do need regulation if we want this market to increase, to be adopted even further. Now the thing is that in my opinion, regulation in the crypto market is going to proceed differently than regulation in financial system. because regulation in crypto market with permissionless blockchains and permissionless smart contracts, potentially anonymous smart contracts, the regulation is more on the voluntarily basis rather than excluding basis. The regulators will not have the power to exclude actors who do not, or it will have limited power to exclude actors who do not comply with regulation. So there may be more of a competition that some protocols and some participants would voluntarily subject themselves to regulation to be more appealing to the customers. But at the same time, there will be very limited power of regulation to regulate smart contracts that are clearly going against the law, but we cannot identify people who set them in motion. And we cannot really stop those smart contracts, even though we know they are Ponzi scheme, or we know that this is a blockchain that allows for front running. So this is where we need to realize different challenges for regulation in the crypto space that we have not seen in the traditional financial space, where every time you're setting up something, a bank or whatever commercial activity, you need to show your identity, and therefore you are visible to the state and regulators.
Hannah, Dick, I'm so sorry. Could I jump in on that? Because
absolutely.
I think, Hannah, that is such a good point. And I think, DeFi is a really great example. This is a really hard problem for regulators, right? If the SEC thought the ICO boom was hard, like addressing DeFi is 1 million. I don't know. You're probably better at numbers than I am, but 1 million times harder, right? To my mind, as a pitch, right, for a possible regulatory approach, is use carrots, not sticks, right? And I think, unfortunately, this is not what we're seeing in the regulatory world. Oh dear, I think I froze.
While Jai is getting back in, let me just add,
Oops,
I think that,
sorry.
There you go. Okay, great.
Yeah.
Please continue.
I'm sorry, where did you lose me? I'm so sorry.
No, I was just going to fill in if you couldn't come back, but please go ahead.
Sorry. Yeah, I was saying that, enforcement seems to be where the focus is for regulators at the moment, right? But imagine instead a mechanism to allow DeFi participants to come in to a right-sized regulatory regime that they can comply with, that doesn't destroy the business, doesn't destroy the activity, but gives comfort that, for example, customers are getting the disclosure they need, the information about the services that they need, that there are minimum financial crimes compliance obligations on participants in the system. I think what you would see is the big institutional participants with lots of money in the system gravitating towards those more regulated venues. You're still going to have the unregulated ones who are in the dark, but you would have that anyway. I think people want to comply, actually. Serious market participants want to comply, and more carrots would help them rather than just the stick.
Right, and that is so important because all of you have used the word trust, which is the essence of being able to transact in financial markets and in the financial system. Lacking it, you can't really do that. And if you build the trust, and if regulation helps build that, which I think everybody here agrees is important, then that's really sort of foundational for what we think about in terms of regulation. One of the things that Hanna and you, Zai, pointed out is that implicitly, we have a regulatory structure that's based on who we regulate, right? We regulate entities. And, we've talked a lot in the things that I do about what we regulate as well. The activities, for example, is one approach to thinking about that. And there are other aspects of our regulatory structure that sort of let us down. One is that we have this fragmentation in our regulatory structure where the CFTC regulates commodities, the SEC regulates securities. So this may seem like a narrow, really arcane question, but it is a legal question. Are crypto assets securities, commodities? some aspects of both? And, what are the implications for regulation? And more broadly, what about the activities and the, what we regulate as opposed to just who? Sai, I'm going to start with you on this one.
Sure, I think it's a fair question for a lawyer. So maybe I'll dispel a couple common misconceptions. First, an asset can be in more than one category, right? I'll give you an example. Currency is also a commodity under the laws, right? There's nothing that says it can't be both. Technically, very technically, securities are also commodities, just not regulated by the CFTC because the SEC gets to regulate those assets, right? Economists think of money market fund shares as a kind of money because sometimes it functions as money, right? So I think that the answer is a very classic lawyer answer, which is it depends, right? But I think this is a question that has been a focus for market participants and regulators. And I want to talk instead, than answering your question directly. I want to talk about instead why it matters, right? Why it matters, which assets are what type, right? And I think this is important because it sort of explains why we are where we are, where we have this ongoing, very heated discussion about what assets are securities and not securities, right? Because if a digital asset is a security right now, the full weight of the federal securities laws comes crashing down on the head of that asset, right? It can no longer be traded on a crypto exchange. It needs to be traded on a national securities exchange. Intermediaries all need to be broker dealers. Query whether the blockchain on which that digital asset is recorded, cleared, and settled needs to be a clearing agency registered with the SEC. How does that even work? How can you even do that, right? And if it's not a security, what happens? We say the CFTC regulates commodities. It doesn't really, right? It has plenary regulatory authority over commodity derivatives and only anti-fraud, anti-manipulation authority over commodities themselves. Then you wonder, oh, if it's money, then I guess we have state licensing requirements, but not the kind of full market regulation that the SEC provides, right? It's just a very different regime. And so I think the focus here is because the sort of binary answer, security, not security, money, not money, has like huge, huge regulatory consequences. And sometimes, at least in the security, not security context, results in an asset being entirely useless for its intended purpose, right? And therefore, many market participants have just had to convince themselves, convince others that these digital assets here are not securities, because otherwise their business goes away. And I think the job of the regulators, not that I can tell the regulators what to do, the job of the regulators is to try to lower the temperature by sort of also thinking about a right-sized regulation for the trading, intermediary functions, clearing and settlement of those other types of assets as well. And then that question won't be so important.
Yeah, that's great. Matt, you've been a regulator. What's your perspective from this standpoint?
Well, I've been a regulator, but I'm not a lawyer, and so I would not. I would defer to Jai on the analysis there. But I think she makes a really good point, which is that right now we're stuck in this binary world, which I don't think is particularly helpful. And I think that it's possible currency could be one thing at one point in its evolution, another thing at another point of its evolution. And I think that I think part of she talked through some of the important implications of that. I think really what regulators need to do is, I think this is an area where you have to go to first principles, right? I mean, the problem right now is that, and it's understandable, I mean, it's rational behavior, it's not some crazy thing, is that the regulators are looking at this space and are saying, okay, how do we fit this within our regulatory framework? And the problem is it doesn't totally fit. And so then you get out the shoehorn and let's squeeze it in there. And I think instead, and this is something that I encountered all the time, when I was a regulator, which is that you sort of have to take a step back and say, what are the underlying risks, and how do we mitigate those risks? And it's a really important thought exercise to go through, because if you're just focused on how does this fit within the regulation, I don't think it results in a good result for, for anyone, and for, including the consumers. But that can require, being able to kind of take that flexible principles-based approach, can require some flexibility. And at the state level, you often have, you do have sometimes that flexibility, right? Because anything that's not regulated by the federal government is regulated by the states, and I think there's more ability to create new license categories, or do things a little bit differently and exercise that type of flexibility. But yeah, I'll leave it there.
Oh, that's great. And I was pleased to hear that Suzanne Morsfield earlier raised the BCBS principles, namely that if a certain asset or asset class poses the same risks, then maybe you should have the same approach to it. Again, being flexible. Yeah. And likewise, that you should be technologically neutral about that. Yeah. So regardless of where the activity occurs, you don't want to regulate it just based on the technology. You want to base the regulation on what problem you're really trying to solve here. So with that, Hanna.
So yeah, if I may add to it, because I'm wondering to what extent, especially based on what Jai said, and might follow up later, is if the regulatory approach right now is giving certain prescriptions of how are we going to deal with securities, where they need to be traded, what type of licenses the trading entities need to get. Is it really compatible with this new technology? Shouldn't we have a regulatory approach that takes into account how does this particular regulatory approach work or doesn't work with this technology? Because in a way, for this technology, it practically stifles completely the development of technology. Once you say cryptocurrencies are securities, and therefore you can't really do it on blockchain. Right? Or what you do on blockchain, especially if blockchain is so transparent and you are giving up all the privacy. So once you do it like completely, if it's completely run, let's say blockchain completely run by regulated entities according to the securities law. So is there a way to actually adjust regulation based on technology, or taking into account the particular benefits and risk of this technology?
Yeah, that's a great question. And say, I'm going to come back a little bit to you on that.
Oh, good. I love this question. Hanna, excellent
keep
question.
Going.
All right. So yes, of course, there's a way. That way is very hard, though, given the structure of of the U.S. financial regulation, frankly, financial regulation all over the world. Dick, I'm going to circle back to a point that you made, actually, because I was involved in helping with some comment letters on that BCBS consultation on crypto asset exposures for banks. Those are very, very nice principles articulated in that document. With all due respect, I'm not sure that consultation actually followed those principles, to be honest, because at least from my perspective, I saw lots of places, for example, and not to digress too much into the technical details, but just as an example, the consultation would have treated traditional assets that are documented on blockchain. So let's say an equity security that's just recorded on blockchain as a crypto asset subject to additional op risk charges and the rest because it's on blockchain. Now, to bring that to Hanna's point, though, maybe that's appropriate, right? Maybe there are actually additional or different operational risks associated with activities conducted on blockchain versus off blockchain. I would submit, though, those might not all be additions to the op risk charge. There may need to be subtractions, right? Because maybe in some circumstances, blockchain technology is more resilient than existing technology. But I'll leave that up to the folks in Switzerland to figure that out. But I think it's a really good question. I think some of what we struggle with here is that the blockchain itself is asset agnostic, right? The blockchain doesn't care whether an asset that's riding its rails is a security or a commodity or money or whatever else. That's not true with the rest of our infrastructure, right? We use ACH for cash, and you can't use ACH for anything else, right? And it does care, in other words, not to personify our payment systems, but whatever. But I think like the beauty of the opportunity here is that if we took a big step back and regulators were able to think in these terms, we could have a system where you could have an infrastructure on which lots of different types of assets are traded, exchanged, settled, cleared, and have regulation that's appropriate for those kinds of assets without requiring the same kind of technology silos that you do in other contexts. But I will stop there before I go overboard.
That's fantastic, because I think it leads to some of the specifics that maybe we can conjure up here a little bit. And I love the fact, Jai, that you've talked about one of my favorite topics, the plumbing of the financial system, payments, clearing, and settlement, because people don't often pay attention to that, but that's where some of the great opportunities are, as well as risks, notably operational, cyber, and other kinds of risks that might arise. And I think when we think about this balance that we're trying to achieve here, that is technologically neutral and treats things like for like, you're absolutely right. How exactly are we supposed to do that? How do we judge what the risks are? Don't we need more information, for example? And part of the issue here is there information? Is there reporting? Matt did a tech sprint in which I participated at NYDFS on crypto reporting, and we came up with some answers, but I don't think we disposed of all the issues there, Matt. How do we think about balancing innovation to address market failure, protecting consumers, investors, issuers, the financial system? You alluded, Jai, to financial stability issues, and to assure market integrity and functioning. So, Jai, going to start with you again.
Yeah, it's a good question. I think the way you framed it as a balance is exactly the right idea, because look, I'll be honest with you. I've had many conversations in the past 4 or 5 years where people will tell me, but it's blockchain, it's totally different. You don't need to worry about it, right? Like, that's ridiculous. That's ridiculous. On the other hand, you've never heard that, Matt, I'm sure.
I've never heard that.
Not from any of my clients.
This time it's different.
Yeah, Matt probably heard that 30 times a day, but whatever. So, I think that balance is important. And I think it's to Matt's point about first principles, right? That's really the solution here, right? Regulators do this all the time when they're confronted with something new, which is, what are the consumer protections that we should care about? What are the financial crimes risks that we care about? And why is this different? What financial stability risks really are there? And why is this different than what we have already? And how can we increase scrutiny of it or recognize that there's some risk mitigants? But look, that's really hard work, right? That takes a lot of education, both on the part of industry to understand what regulators expect, and by industry to help educate regulators on what it is they're trying to do and why it's a good idea. And I just think that's a very hard, that's a harder task, right? Than, cramming, was that the word you used, Matt? Cramming these activities into existing regulatory categories, which may not be the right fit and may not always win in court, but will slow down the innovation.
Yeah, Hanna, what's your perspective on this issue or these issues?
Yes. So I think that I'm connecting here with both Matt and I said before, that on one hand we have silos of infrastructure silos that go along with regulatory binary categorization, and now both of those structures do not fit into blockchain, where the infrastructure is asset agnostic. And what it relates to the fact that it's really difficult to just put put one agency in charge of this of regulating this. And what is also related is when we talk about crypto assets, and even like when you ask, what are crypto assets, or securities, or commodities, and so on. So it's not only that a particular asset can be both at the same time. Just crypto asset is hiding, the term crypto assets is hiding such a diverse landscape that many of them are very different. Some, are stable coin security. We have heard David talking earlier how stable coins are not securities, and security mission should not look into that direction. Are utility coins securities? Are they commodities? Are they right? And are NFTs representing Bipley's work? Is this how is that security? Or is it commodity? So all of those crypto assets are very different. So how are we going to get and put it into one type of a regulatory framework versus different regulatory framework without even even if we do that, then it's going to prevent new types of those crypto asset classes coming out and being innovated, right? And NFTs, we have not seen this type. I mean, NFTs have been developed in 2017, but until 2020, we did not see that particular use of NFTs that we're seeing right now. So there are many more innovations, and they will be different from the point of view of what type of risks and what type of benefits they are providing, and therefore which regulatory agency should go, and how can we shoehorn it into the, I'm like, when Matt was talking about shoehorning, I was thinking about Cinderella story and that, two step sisters, and how you're cutting the foot to fit the slipper. Aren't we in this type of scenario here?
Yeah, good question. And, I was part of an organization or a collection of regulators that tried to bring together all the regulators' perspectives on financial stability, the Financial Stability Oversight Council, which was created to address those problems, those coordination and collaboration problems. And it's, it sounds like, this creates, what we've done here is a technology, or created a technology that with it brings all kinds of coordination problems across the regulatory space, particularly in the United States, where it is so diverse. Matt, any thoughts?
Yeah, a lot of thoughts. I'll try to kind of keep them brief, but I think that, just in terms of like a framework to think about how regulators balance innovation and regulation, I think that there are three critical questions. So one is, what are the rules? Second question is, who has to adhere to those rules? Who? We've talked about that. There's issues with that. But then the third question is like, how do you ensure compliance with those rules? And there's sort of, and what I'm trying to highlight is the distinction between regulation and supervision. So, regulation are what are the rules, and who complies with the rules, and supervision is then how as a regulator the tools and techniques and approaches you use to ensure compliance with those rules. And I think that they're related to each other. And I want to start just briefly on the supervision piece, because Dick, you brought up data and reporting. And I think part of the challenge regulators are facing is that the tools, the supervisory tools of the past are not particularly effective for the future of finance or for DeFi or any of the things we're talking about. Traditional supervision tools are labor intensive, involve on-site examinations, and those things, there's probably still room to do some of that, but that needs to be augmented with entirely new types of tools that can give regulators greater and more real-time visibility into what's happening in the market. And that's where I think regulators should actually be very excited about crypto, because I think crypto if you think crypto is the future of financial services, and financial services will look more like crypto in the future than vice versa, then it opens up a whole new world of supervisory techniques or tools, right? I mean, once this data is on the blockchain and can be leveraged, I mean, there's the potential to supervise in a totally new way, and in a way that is much better in the past. So I think that supervision is important. Supervision is important for the reasons I mentioned, but also because, my hypothesis, my view is that as regulators get more data, more information, more visibility, it will help them become also more comfortable. It's easy to be afraid of something like the monster in the closet, right? But once you open the door and you turn the light, you see that it's not actually a monster, or it's actually not a very scary looking monster or whatever, right? And so I think that there's real benefit to the industry in regulators getting these tools, because I think it will drive greater confidence in the market. The second thing I wanted to say, though, quickly on kind of so that was supervision, and then on the regulation side, is I think as a regulator, it's challenging because the space is, for many different reasons, including that it's just moving so quickly. It's really hard to, working in the industry, it's hard to keep up, and then regulating in the industry, it's even much harder. And there's sort of two things you have to do simultaneously, right? You need to bring these new products and services and players into the regulatory tent, and at the same time, you have to develop a regulatory framework, right? I mean, we know it's not the approach of developing the framework and then applying it is not really going to work here. I mean, it has to be done iteratively, and so I think that regulators need to think of creative ways to bring some of these products and services and companies under the tent with a lightweight type of licensing process, and then see how those companies evolve, and then build the regulatory framework sort of in an iterative way. But I mean, that's not that's sort of not the traditional way of doing it. But I really don't see any other option. I mean, because the space is going to continue to evolve. It's not like we can just wait. I mean, it's going to continue to evolve for a very long time, and so we have to think about how we develop these rules in a different way.
Yeah, that's
Can I
great.
jump in on that, Dick?
Yeah,
So
please.
sorry, I feel like just get very enthusiastic. So Matt, to Matt's point, I think there's actually something really interesting going on. I think we've been focused on how do you regulate the Wild West, which I think is a hard problem. But there's also this very interesting conversation going on with US prudential regulators, federal banking regulators, about should banks be able to get involved in these activities. I think Matt at the beginning of the panel talked about how banks are having FOMO, and they're starting to think about how to offer these crypto services to their customers, seeing how sticky those crypto customers are on crypto trading platforms, and now PayPal and Square and the rest of it. The banks are like, I also want those very sticky young customers who will be with me for a long time, right? So they're all thinking about how to offer these services. And along with that, because those banks are prudentially regulated, right, they have to have these conversations with their regulators about how they're offering the services, what services they can offer, how existing law applies to those services. And I think that the bank regulators, I think, are being either forced for some of them, or enthusiastically being brought along to the view that this is inevitable. Banks are going to want to provide Bitcoin, ETH, buy, sell, hold services to their customers in the near future. And providing sort of an incremental way for that to happen is actually also a way to bring firms inside the tent for regulators to learn about those services and all the risks and rewards attendant with them. And I think that supervision process is actually, to Matt's point, exactly how you get there.
Yeah, I was going to say, I couldn't agree more. We now have a whole set of processes which we're calling RegTech, which enable the regulators to use technology to facilitate and improve the process of regulation, make it less burdensome, make it more cost effective. And one of the things that I think goes along with that is, Matt, you implied or alluded to this, I think, is not only do we need collaboration among the regulators and getting together because of the cross-border, if you will, nature of what we're talking about, but also better collaboration and dialogue between the regulatory community and those they regulate and the people in the industry, so that the regulators can learn more effectively about what we're talking about here and how the technology is evolving. And in addition, the people in the industry are going to have clarity about how they can develop things so that they make sense and build trust in the whole system. So speaking of that, my last sort of formal question relates to privacy and anonymity. So if anonymity is a characteristic of a lot of these assets, then we all think that there might be some risks that poses. For example, in financial crime, illicit transactions, and so on. And how do we balance privacy and protection on one hand against the crime, fraud, and errors on the other? And Hanna, I'll start with you on this one.
Yeah, so I had exactly this thought when Matt was talking about the benefits of blockchain to oversight. Right, because when you have everything on blockchain, imagine you have everything on blockchain, you actually get to see everything, and that may be exciting for regulators, but probably equally scary for big parts of population, especially in a country like US. Right, there are other countries that we may think of where people are not so sensitive to that, but I would worry about any one agency seeing everything that is on blockchain once we get everything on the blockchain. So how to balance that? And I think that just goes to a broader discussion of having more information versus connecting this information. And I think that in US, yes, we are complaining about the siloed regulatory agencies and federal agencies and agencies that are collecting all sorts of information, not connecting between each other and not connecting this information. But what I have learned when I came to US is that this is on purpose, because we don't want any one agency to get all this information in one place. Whereas in other countries, you have by default all this information in one place and agencies communicate with each other. So if this is on principle, how are you going to reconcile it with this regulatory oversight when all the information is in one place and this information is visible and individually identifiable? And that is, this is my question to the other panelists who have more experience with actually, how does the regulation work and what are the principles, especially in US. Then you need to think about, we are talking about regulation in US while blockchain and DeFi and the activities, crypto activities are inherently global and cross-border. Right? Yes, you are going to, if you fully regulate and have the blockchain that is clearly seen to any regulatory body in US, are you shutting down this particular blockchain to anyone else? Because will they want to participate in a blockchain where US regulatory agency sees everything? So I think that if you don't think about balancing, you are going to have those regulated sandboxes, and I know that I'm using the word sandbox, regulatory sandbox, in a reverse way, because this will be like a walled garden that people from outside of US may not want to participate. You're going to have, yes, so it's not like Facebook and Amazon, which is global, but you are going to have like completely local blockchains, which defeats a lot of the purpose of blockchain. And then at the same time, if we want to have all this insight into the blockchain, because we want to prevent anti-money and want to prevent money laundering, terrorist financing. Going back to my earlier comment that this regulation on blockchain is not exclusatory, it's not excluding players who are not adhering to regulation. I don't think it's going to do anything for the anti-money laundering and know your customer and anti-terrorist financing regulation, because it will still be this whole blockchain and crypto assets and cryptocurrencies that will allow for those illegal activities. So, so I actually, I think it's a very difficult question. Yes, you can have some services where where anonymity is not an issue, and you're, you would be fine with full identification of individuals. But what is happening with typical services and kind of financial services in US, I think, is that there is not a direct observation. There is a credit cards, see what the banks see, how their clients are using their money. Credit cards have connection to the banks, but does not mean that the government can just look into it. So how are you going to have multiple removed steps with blockchain? And I don't know how to implement it. You would need to create, again, a new type of technology that would be maybe complying with this regulation, with the need to balance privacy and regulatory oversight.
Matt, how do you respond to that?
I think, well, I've been thinking about this headline that was in the, I should have looked at before. That's like New York Times or Journal or something like that. Kind of after in the context of the Colonial Pipeline hack, and there was the headline was something like, turns out crypto's not as private as we thought, or something like, and because and I think for those of us that kind of work in this space, it was sort of kind of an aggravating headline in some ways, because I think most of us know that blockchain, even if there are anonymous aspects of it, law enforcement is actually able to identify and go after wrongdoing pretty effectively, right? And I think the Colonial Pipeline hack was a good example where the FBI was even able to recover a significant amount of money. And so I think you can have both. I think you can have privacy and you can have the ability to enforce laws. And I do think that privacy needs to be an important principle. Actually, I think that, like, as government is developing policies and regulations around this space, it should be an important consideration. And I think with cash, it's less of a consideration because there's no ability to really. I mean, there's no way to enforce that. Crypto is different because you could conceive of systems in which there is no privacy and everything is visible. And so because it's possible, of course, doesn't mean that we should do it. And I think we as a society have to be very conscious and intentional to build in base privacy protections.
Great. So Sai, you're a lawyer. What are your thoughts about this?
That's a hard act to follow from both my co-panelists. I'm not a data privacy lawyer to start, so I'm going to answer this again a little bit differently. I mean, I think at its core, what this debate ends up being about is whether crypto assets like Bitcoin and other assets that function as money should be treated like cash, or we should think of them more as intermediated financial products like we do bank accounts or brokerage accounts or the like, right? I think, being able to transact and hold money anonymously is actually really important, like as a fundamental, like constitutional type right, I think, right? Not all countries think this, for sure. I think in the US, we take it for granted a little bit, right? Because we do still have paper central bank money that we can use and transact anonymously, right? Until it gets to be too big amounts. But I think, just to be really frank about it, I think the ship has sailed a little bit, and regulators don't really accept that Bitcoin, Ether, stable coins are like cash. And I think Matt really hit on why, right? That fundamentally, they're not heavy in the way that paper cash is heavy. You don't have to carry a suitcase of it around or a big old duffel bag to try to, conduct sizable transactions. There's just a lot less friction to conduct large transactions in crypto than there is in paper bills. And so I think, that ship might have sailed a little bit, but I think now to totally pivot to Hanna's point, what will it take to protect privacy then in this new world on blockchain? In my own imagination, again, the answer is some form of digital identification that really works. Digital ID that's owned by individual users, the information about them is owned by them, and can be revealed in encrypted ways as needed, right? The classic, the bartender doesn't actually need to know my address to know that I'm over 21. I just need a credential showing that I'm over 21, right? That idea I think is actually possible, in the world of ones and zeros. We just have to find a good way to do it. And luckily we leave that hard problem for the technologists to actually crack.
I'm glad you raised that, because I think our keynote speaker at the end of the conference is going to maybe talk about some of that. So we've covered a lot of ground. We have a few minutes left. Let me see if there's anything we missed or any final comments that you want to make. And again, I'll start with Hanna for that.
Well, I found this discussion fascinating, and I don't have anything specific to add, but I think that I really like the point that Matt made about we still don't know what are the potential benefits to the technology, because it's a potential. And therefore we need to be really careful with regulation and our regulatory approaches to really see the full potential, and while attempting to mitigate the cost, right? And what also said that we need to be maybe very if as far as we can recommend to regulatory bodies to think about it in a less siloed way to the extent possible.
Great, Matt.
Nothing big to add. I guess my only parting thought would be that the rules matter, how you supervise matters, but the process matters in a way even more, because the point I was trying to make earlier that the space will just be forever evolving. And so I think that as a community, as an industry, and regulators, everyone, we need to figure out what is the right process for iteratively building this regulatory framework, because there's clearly no sort of process right now, and I think if we want a result that's good for markets and good for consumers, right, we need to be a little bit more intentional about how we design and build that framework.
Terrific. Jai, you get the last word here.
Yeah. The only last words I have, I think, are that I think bets against technological progress are always or almost always low-losing ones. I think that, yes, the innovation can be scary for regulators because it's complex, it's quite different, it's something really new. But I think what we've seen in the past 6 months even is that it's really captured the imagination, the interest of not just, I think Hanna referred to them as the early enthusiasts, right? It's not just the early enthusiasts anymore. Crypto assets are becoming mainstream. I think it's hard to put that genie back in the bottle. That is a lot of mixed metaphors, but I think don't bet against the tech. And I just hope that we find a rational way to regulate this, that, in your words, Dick, balances the innovation against the important policy goals that underlie our financial regulatory system.
Terrific. Well, I want to thank all of you, terrific panel, for joining us today and providing so much insight into these issues. Not that we've solved the problems, but I think we've raised the right questions at least. And that's a good start. And we'll continue to work on these things, as April and Amal said. You know, we have a lot of more thinking to do on these issues, and dialogue like this I think really helps us do that.